So when most prospective clients realize that we use largely passive indexes and ETFs for our publicly traded portion of our investment portfolios, especially our flagship portfolio, they're sometimes surprised because they feel like a portfolio manager should be picking stocks and making all these transactions, doing all this research and having a lot more elaborate activities. But remember, there's 3 reasons why you'd want to own an ETF over the actual, stock picking universe. The first one is the probability. 95% of professional advisors, not just investors, but professional advisors over a 10-year period fail to match the performance of the market. So rather than owning the S&P 500, they think that they can outsmart all the other smart people by picking stocks and managing a portfolio over time. Yes, they might get away with it in the short term, but over the long period, it's been proven time and time again, decade after decade, the stats don't deny, it is very, very, very difficult to outperform the market. The second is the costs are remarkably low. You can buy these indexes for less than 5 basis points in an ETF. That's, that's almost free. Compared to a mutual fund where you're paying 1, 2, 3%, or a portfolio manager to pick stocks, you're going to be paying upwards of 1.5 to 2%. Just doesn't make any sense. And then the third is for tax efficiency. All those transactions, especially if it's in a non-registered or corporate account, that is going to incur capital gains, and that churning and that management is going to force unnecessary tax. Whereas if you just carry the S&P 500 all the way through, knowing you're going to outperform 95% of advisors anyways, but you're going to have very little taxation along the way. It's just a smarter approach. But what I'm going to show you today is just because you have a passive approach to investing in the market doesn't mean you have to be passive about it. So what I'm going to show you is how we actively change our strategy as the market adjusts through the business cycle. When we hit a period of volatility, what do we do? And so let's take a look at, in 2019, the market did remarkably well. So good year, we're bouncing along. We get to early 2000 and we're at what was the previous peak up to that point. Then obviously the dreaded COVID hits and we drop significantly. Minus 40% at the low was the S&P 500. So now, yes, we can carry it all the way through. Everyone knows that if where we're sitting today, the market recovered exceptionally well. That's a given. However, what did you do to maximize that recovery without incurring a bunch of additional risk? So just because the market is going to sway like this and you want to carry the passive index over time doesn't mean that you can't manipulate and benefit further from that recovery. So in this point here, as the market recovers and we're at full valuation, you would want to own the S&P 500, for example, the straight index. When the market drops, what you would want to do, and this is what we've done like clockwork over the last 10 years for our clients, is we go to the bank trading desk and we create a structured solution around the exact same index, the S&P 500, but what they're able to do is give us a multiplier to the upside with the same 1-to-1 downside risk. Virtually a no-brainer. And so back in the end of March of 2020, we were able to set up a 1.55 times multiplier on the S&P 500. So recall from probability, what is the chance of an advisor beating the S&P 500 over a 10-year period? Less than 5%. What is our chance of beating the S&P 500 with this structure? 100%. We are going to get 50% greater return just by owning the same asset. So if you strategically buy it in bouts of volatility, as the market recovered, you're going to get an additional 50% upside on the exact same return that is going to outperform almost all professional advisors. We do this time and time again throughout the business cycle for clients, and it works masterfully. Currently, that S&P 500 note is trading at about $204, and we bought it at $100. that means that we've had 104% return on that exact same investment. But remember, the market hasn't went up 104% in that period. So we are outpacing the market with the exact same risk exposure. Just a smart way to play it. And like I said, because we know that we are going to outperform with 100% probability, it just seems like a smart way to approach things.